Well, hello everyone, and welcome to a very rainy, windy, kind of chilly election day real estate update here in Southern California. My name is Stephen Meade with Domicile real estate for people who love houses, which is hopefully you if you are watching or you at least love real estate. And this is our Southern California housing market update, mainly pertaining to Los Angeles and Orange counties. That's where we run our own stats. So, not clickbait this time. We're seeing something that's very troubling, and believe it, we're going to get to it. It's probably on our second to last slide, so you're going to have to bear with all of it, and then we're going to talk about what this might mean and what this might hold for the future. So we're going to break down what are we seeing, how could we possibly be misinterpreting this, what are some alternative explanations, right? I think sometimes when you get hung up on one variable, sometimes you get hung up on that, but really something that's kind of a big change that we need to keep an eye out for, because this could be the sign of something changing in a very drastic way. So I'm not going to withhold it anymore. Let's go ahead and jump into it. This is, like I said in the description here, I think this is probably one of our most important updates in months. So here we are with our total number of active listings, right? And this is actually some maybe good news for kind of a healthy market, right? Like, these numbers are going down, not terribly quickly. We still have elevated inventory versus where we were at last year. I think last year we were at 7,500, 7,500 houses for sale. Right now we're at around 1,050. So, maybe up 35% in terms of just number of listings there on the market. That's not a huge number really, and it's not continuing to climb out of control. For those of you who were around in 2007, 2008, I mean, you just saw inventory saw no end in sight. That is not what we're seeing. If we take a look here at our new listings, really what we're seeing is a huge drop in supply. So this time last year, we had almost 4,000 new listings coming up every 2 weeks on the market. Right now, we are at about 3,000 listings. So new listings themselves are down almost 25%, right? So while inventory is up, overall new listings are down. And that's why we're not seeing that runaway inventory growth that I think a lot of people would expect to see. And it's just not happening. It's elevated inventory, but honestly, it's not really anything above long-term averages. If we look at our new escrows over the last 2 weeks, this tells a story of greatly reduced demand. So we've got reduced supply and reduced demand. And that's really tempering a lot of the effects of what we're seeing in the market, right? The market is always about a balance between supply and demand. So if both of these are going down, what we're really seeing for the most part is a reduction in the number of transactions taking place. So if you look here, I mean, we were roughly 1,400 new escrows and maybe 700 between 1 and 2 million. So basically 2,100 new escrows versus 3,600. So I mean, this is a pretty sizable drop in new escrows, but again, we also had a sizable drop in new listings. And where does that put our supply demand balance? Well, it puts us right here in kind of this 60 to 70% zone. That is actually a fairly balanced market, believe it or not. I know it doesn't maybe seem like it. If you're a seller, you might be sitting here saying, why are buyers not beating down the door to my house? And if you're a buyer, you might think, I have all the time in the world to buy. The reality is this is a fairly normal looking absorption rate in our market. This is long-term. This is about where it settles, around 70%, 60 to 70. That's a pretty normal number. Let's talk about closed prices. And again, this data is 4 to 6 weeks old because it is based on things that have closed. At the upper end of the market, where are we trading? Well, we're trading right about where we were beginning of last year in terms of pricing at those 75th percentile homes, like right around in that zone. So basically about where we were last year. Similar news here in our median, maybe a little bit better than we were, at this point last year. Definitely a little bit higher than that. And then kind of the same thing true here on our entry level 25th percentile, right? So these are kind of these the first quarter of the market, the middle of the market, and then the top quarter of the market, right? When we're looking at these. But remember, some of this data doesn't necessarily include kind of the latest round of mortgage rates. And I'll get into that in a second. Now, if we look at our percent still active after 14 days, what you saw is this number was low, it climbed, and then it's kind of settled out, right? It's not really growing at a huge rate anymore. That's really to be expected. Again, that's a sign of kind of some supply and demand balance in our market. And then if we look at our close to list ratio, our 1 to 2 million, we're here just under 100%, and we are just under 99% here on our under 1 million. I'm watching this under 1 million. Is this just a fluctuation? Is this going to bounce back? Historically, right, we are between really that 98 and 100% point. Like, this is the normal spot of the market, right? That on average, listings go for, anywhere from 0 to 2% under their list price is where they end up closing. If we look at our days on market, that number has gone up. And what's interesting is that number right now is higher for our under $1 million homes than it is for our $1 to $2 million range. It's actually right around like 42, 43. It went off the edge of our scale here. That number has kept climbing, but in a rather steady manner, right? Like, this wasn't an overnight shift. This is over months. But that's definitely one trend to look at. And then here we're going to get to the meat of it. And this is where we're really going to spend a little bit of time today. So just as a reminder for what this graph is showing and what we're looking at, is we are looking at the payment on a median priced home, the CPI index, and the rent on a median single family home in Los Angeles and Orange counties. And we've indexed them together to see how have they moved in relation to one another. And one of the things that I think is incredibly important for people to look at is the difference between this blue and this yellow line, right? This difference is where you see that sort of the buy versus rent opportunity, that those economics have become out of balance to some degree. And you'll notice back here at the beginning point of the year, when interest rates went up, see the payment line going up like this, there was a delay, and then we saw the rents come up. And then they mainly played together, right? Like, there was a little bit, they were a little bit out of step from each other. But look what has happened here, right? In the last, maybe 3 weeks or so, right? Or the last 2 weeks, we've really seen these numbers widen apart. And, economically speaking, this is something that cannot exist in the long run, right? Like, something will have to change between these two numbers. Either interest rates or prices will drop, or rents will come back up, or there will be some reckoning to get these closer together. This is a situation that cannot exist out of whack in the long run, right? And admittedly, if we go back as recently as maybe a month or month and a half, these were a lot closer together. So in the grand scheme of time, these have not been spread apart, but I'm looking at the direction these are going, right? And that's telling me that maybe we have a little bit of something here, right? Maybe there's a little bit of a problem brewing here, and something is going to have to adjust on these. And so let's break down the forces that are working on both of these, right? What is making this rent number drop like this, right? What would explain this? And I mean, this has been over a month cycle here. So I think this is more than a blip on the radar, right? Like, we're gonna have to call this a real trend. So what could be causing this? And, the answer is actually in, I think, a previous graph. I think we are in a situation where there are a number of people who were planning on selling and either abandoned those sale efforts or changed their plans and didn't put their home on the market at all, and decided to rent their property out instead. And when they did that, that increases the supply of rentals, and that ends up pushing this line downward, right? So I think that might be the primary force that we are seeing on this rental market, is we are seeing more rentals come into the market. The other effect that I think might be at play here, and this is an important one to understand, is I wonder if the quality of rentals is going down. And if the quality is going down, that would also pull down that median rent level, meaning maybe the homes that are coming on the market now are people just giving up on selling. They're not doing a lot. They're just putting it up at whatever to get somebody in there, and they're going to try again in a year to sell it again. So they're not really putting money into these houses. They're not really looking to maximize their rental dollar. What they're looking to do is just get some money coming in the door to tide them over for a year, and they're going to re-examine selling in a year. And if that's the case, that might explain some of this drop, right? Why some of this median is going down. But it's important to remember, though, that's still a factor in this. If you are looking at people, especially at that entry level into the market, they have a choice. They can either buy a home or they can continue to rent, right? That's the choice that they're looking at making. And even if some of these options might be crummier on the rent side, the fact that they exist, right, that they're out there, is still meaningful. Okay, so that's kind of what we think is happening on this rent line right here. By the way, next update, we're going to have a new inflation number. We're all curious to see what it's going to be. I think it comes out in 2 days. They're going to release those inflation numbers. But that brings us up here, this number up here. What could happen up here to reconcile things? Well, really, there's only 2 ways for this number to move closer to rentals. Either interest rates drop or prices drop. Like those are our 2 options. The other thing that's going on here, and I'd be remiss if I didn't mention this because I think this is important. When we started calculating this payment index, and this is incredibly important, so I'm going to probably say it twice. When we started calculating this payment index, we did it based on a 30-year fixed mortgage. That was predominantly what consumers in the market were obtaining. Now, especially in our Southern California market, where many buyers qualify for jumbo loans, we are seeing that the vast majority of those buyers are pursuing ARM loans at lower interest rates, right? And if you are taking an ARM loan at a lower interest rate than a 30-year fix, maybe even a full percentage point or more lower right now, we're starting to see a widening gap. That means that this blue line for most buyers actually in the marketplace might be down about here, right? It might be in this level here. And at that point, it's not terribly out of line with where it's been. And, honestly, that might make a difference in kind of this analysis that we're doing here. And this spread might in reality not be as big as it looks because we are calculating it based on a 30-year fixed payment, and that is no longer the predominant form of financing in the marketplace. I know for our own clients, we have told them definitely look into ARM loans right now. There is a very high probability in the next 7 or 10 years that rates will be at some point in that 7 or 10 years where they are lower than they are today. We think there's a very good chance that that will happen. So where are we at mortgage rates, right? We are just flirting with this 7% level. And, there's a lot of talk in the market about where rates are going. And I'm going to kind of go off screen share here and talk directly to you about this. So there's a lot of talk about where rates are going. And honestly, if I could predict where rates are going, I wouldn't be sitting here making videos. I'd be a bond trader and I'd make tons and tons of money and I'd be on a beach somewhere by now. But the general predominant theory is that rates are going to continue to go up to some degree in the next 6 to 12 months. They're going to peak and then they're going to start falling off, right? And that's one dimension of this, right? Even if that turns out to be true, which we're not sure it is, this is just conjecture and sort of general sentiment. One of the problems with oversimplifying it is that that is talking about where 30-year fixed rates are going. And as I just mentioned, that is no longer the predominant type of financing being used in this market. If the shape of the yield curve should change drastically, there might be an even bigger gap between a 5-year ARM loan and a 30-year fixed. And if that gap is 2%, I can tell you almost everybody will be getting the 5-year ARM. And that will really realistically change our market dynamics should that occur. So, most people think about this rate equation in 2 dimensions, rates and time, right? But the reality is there's a third dimension to it that you have to factor in. And that's what makes calculating some of these things so hard. So, the next few months are going to be very interesting and possibly even pivotal in our market. there are a lot of things that could be changing, and we have a lot of uncertainties in place. If that yield curve changes and those fixed rate more and those adjustable mortgages suddenly become much cheaper, that will have a very profound effect, on buying habits and what buyers qualify for and what buyers see as their bottom line payment, right? Especially when comparing against rents. So, we also might have had an influx, right, of new rentals. That's going to get eaten up and you're going to see that number bounce back up. So there's a lot of things and a lot of moving parts that we're going to see here in probably the next 60 to 90 days. I think we're going to get a little bit more clarity about what 2023 is really going to look like. Today is also election day. We've got a potential, some might even say probable flip of Congress. So I think, we're in one of those situations where buyers and renters alike, I think, don't want to make a lot of big decisions and big changes around this time of year. So we might even get some kind of movement in our markets immediately following the election, just because people have sort of gotten their grounding on what's going to happen, right? A better feel and less uncertainty. So anyhow, that's what we have for you. You're hearing the best of my knowledge and expertise. Some of this is conjecture. We're trying to look at the data, trying to understand what it means, and also, perhaps even most importantly, trying not to get stuck or hit by something out of our blind spot, right, that we're not seeing. When you look at one variable and you hinge on that, right, sometimes that can happen. So a lot going on. We appreciate you watching. As always, if you are thinking of buying or selling real estate in Southern California, we would love to provide you with individual expertise. You can absolutely reach out to us. We would love to represent your interests. And don't forget to like, subscribe, hit that notification bell. Questions and comments, we love them. Have a great day, everybody. Stay dry. Get out there and vote. You still have time. And we'll see you again real soon.